Okay. Yeah. Hi, everyone. This is Finance Meets Real Estate. We have John Errico here today. John is the founder of Liberty Hudson Capital. He's a fellow investor here in New Jersey, which is where I reside. For most of you who are from other states. So John invests in small multifamily and some single family properties via private equity fund structure, which I found is pretty interesting, pretty unique. As you know, it's very common to believe that to scale, you need to kind of be able to access like higher unit sizes, but it's not always the case. There is more inefficiency at the smaller multifamily in the smaller multifamily range, and he's been able to leverage this inefficiency really well. So I'm very curious what he has to share. Prior to that, John he's an attorney by education. I believe you studied history at Yale first, and then law at Cornell. And he's been a real estate investor since 2016, 15?
14, yeah, more 14, or less. Okay. Yeah.
Okay, great. Yeah. So with that, I'm going to pass it on to you, John. And if any of you guys has any questions, feel free to chime in at any point. If you're feeling shy, you can put your questions on the chat. Either way. And thanks. Okay.
Yeah. Thanks, Stefan. Yeah. Thanks so much for having me. And thanks for building this community. I've watched a couple of other presentations and it's great. And I think, Stefan, we've known each other now for like 4 years, I want to say, something like that. It's been a while. So I appreciate you inviting me to this. But yeah, so as Stefan indicated, today I want to talk about how and why to start a private fund. So I'm going to talk a little bit about what a private fund is, my experience in real estate investing, describe me a little bit why you might want to consider this as a real estate investor, and then my experiences with it, and hopefully answer some questions at the end. But I'm going to be talking about everything from the perspective of you as a real estate like sponsor, like an operator of real estate. So not from the perspective as you as like a passive investor, but someone who's actively wanting to invest in real estate. So as Stefan indicated, my background, I have a BA from Yale and a JD and an LLM from Cornell Law. I practiced law for a few years after law school, and I left that to do real estate investing in 2014. So I kept operating startups. I left the full-time practice of law in 2013. I ran a few startups in California and in New Jersey, but I moved to New Jersey in 2014 and I house hacked a place before I knew what that was, about a 2-family in Union City, New Jersey. I lived in one unit and rented out another unit. Ultimately moved to the basement of that house, rented out the entire house, and bought a second house about 7 blocks away, bought a third house a few blocks from there. So my experience in real estate has ranged from doing very small deals, like buying a 2-family home, all the way up to doing more complex, kind of differently structured products, real estate products, different assets, and all of that. So I started working with investors for the first time in 2015. My first deal was a property in Connecticut, in New Haven, that I bought with 2 friends from college that I'll describe in more detail as we go on. I started investing in Atlantic City in 2017, and I currently operate a small private fund via a company that I run with my co-founder, Ryan Goldfarb. It's called Liberty Hudson Capital. It focuses on investing in qualified opportunity zones in a portion of Atlantic City. And we can talk about opportunity zone investing specifically as we go on. But I also run an affiliated construction business and a property management company to service the investments that I have throughout New Jersey and a little bit in Connecticut. So one disclaimer that I should say, which is very typical of lawyers, which is I am an attorney, but don't construe the presentation that I'm about to give as legal advice. And I also want to make it clear that the presentation that I'm giving is not a solicitation for you guys to invest in any venture that I'm currently involved in. Private equity, as we'll talk a little bit about, is a heavily regulated industry. It's a very complex legal topic. I mean, it's like My wife is a private equity attorney, and she devotes her whole career to understanding how private equity works. So if you're considering doing any of the things I'm talking about, structuring anything I'm describing, please consult an attorney to ask questions and figure out how to do it. I'm also more than happy to talk to you about how to find an attorney or how to structure stuff or whatever else. But so this is the sort of thing that you definitely want to talk to an attorney about before you delve into it. So I want to start with the very basics, which is what is a private fund and what is private equity, because I realize talking about this topic that a lot of people don't really know what we're talking about. So very, very broadly, a private fund is a pool of money or committed capital available to invest, usually controlled by a sponsor, a manager, or a general partner. So you've probably heard of a private fund or private equity. Blackstone, I think, is the biggest private equity firm in the world, I believe. Brookfield is another very large real estate private equity fund that you might be familiar with if you're in New York City, Brookfield Place. The Vision Fund, which is, I think, a $100 billion venture fund from SoftBank, has been in the news a lot recently due to their investments in WeWork that have not gone as well. But these are all different iterations and different types of funds that exist in the world. I think there's something like, there definitely are trillions of dollars invested in private equity throughout the world in different capacities. So funds can range in size from thousands of dollars to billions of dollars. But one important thing to know is that in general, regardless of the size of the fund, private funds are governed by the same laws. Doesn't matter how large they are, more or less. And that could be a good thing and could be a bad thing, depending on your perspective. Funds are called private because they're not listed on a stock exchange. So interest in funds are illiquid because of that. So unlike buying a share of, a publicly traded stock, when you have an interest in a fund as an investor, it's very hard to sell that interest. That's one of the downsides of a fund that I'll talk about as we go on. Private funds rely on exemptions to federal securities laws. And that's the complexity of the legal topic that I alluded to before. We'll touch on that a little bit, but that's one of the reasons why I would recommend, and I would say if you're going to do this, you definitely need to speak to an attorney who's familiar with structuring private funds and has experience in that realm. The term private equity, which you've probably heard thrown around, is a general term describing investment funds. So you can have real estate private equity firms like Blackstone and Brookfield. You can have venture capital firms like SoftBank's Vision Fund. You can have funds that do distressed investments, et cetera, et cetera, et cetera. There's like a type of fund exists for every method of investing you could ever conceive of. So what I'm going to be talking about specifically is using private equity and private funds in the real estate context alone. But the world is the limit in private equity. So before we get into why you would want to start a private equity fund, why I did that, how it could be an advantage to you as an investor, I just want to describe some typical features of a private real estate fund. So very typically, money in a fund is raised to buy multiple assets or pieces of real estate. It is uncommon for a fund to buy a single asset unless it's like a skyscraper in Manhattan, or maybe like a commercial development or a mall or something like that. Typically, due to the complexity of raising a fund, usually you're buying multiple things through that fund. Very typically, there's one active investor, which is the general partner or the managing partner, and other investors are passive. So they are not involved in the activities of the fund. And investment decisions for the fund are made by the general partner or the manager. So in everything I'm talking about, I'm sort of envisioning that you guys as investors would be that sponsor, the general partner, the manager of the fund. So in a typical private fund, that person or entity is the only person making investment decisions. Typically, there are distributions of available cash. That's cash that's generated from rent if you're doing a buy and hold strategy, or selling the property if you're flipping or doing something akin to that. Very normally, investors will receive their invested capital back first. They'll receive a preferred return which is like a guaranteed return on their invested capital. And then after that, the general partner will be compensated in some sort of split. And that's typically called carry to the general partner. The general partner also charges fees, and those could be an investment management fee payable to the general partner or the investment manager, an acquisition fee for properties, construction management fees, property management fees, and so on and so forth. That's typically how general partners will make money when the fund is operating before the carry, before the end of the fund. And very typically, funds will have a limited and predefined time span before liquidating assets. So it's, somewhere between 4 and 10 years. 6 years is very common. My fund has a 10-year period of time, and there's a specific opportunity zone reason why we do that. But so these are differentiators that you might find from a fund versus some of the other structures that you could imagine investing in real estate in. So I want to take a very simplistic approach to talking about why you might want to structure your investments as a private fund, and starting with all the different ways that you could essentially buy real estate. So like the very basics to the more complex. So in my mind, the most basic way to buy real estate is with cash. So I bought real estate with cash before, usually cheaper properties because I don't have that much cash. But I think the concept is very simple, right? You buy a property with cash, you see how much the property costs. You look at your bank account and you say, I have more money in my bank account than the property costs, and you wire that money over to the seller or to the title company. So the pros of buying with cash are that it's super easy to close. I mean, it's you could close in a day if you wanted to, if you didn't care about title insurance. It's very, very little legal and financial complexity. Again, it's signing maybe one document as a buyer to buy property in cash. But obviously the cons are that you need to already have cash. And unless you're already wealthy, you really can't buy that many assets or that many properties. And if you already have a lot of cash, you're probably not listening to this presentation because I would assume that most people are looking to, make more money through real estate or figure out how to be successful in real estate. So as I said, I bought properties in cash before, but as an investment strategy going forward, it's not really scalable for most people. So what most investors are familiar with and how I got started is buying property with debt. So in the real estate context, that's a mortgage. The pros to buying a property with debt are that it's fairly easy to obtain a mortgage, all things considered. You can put a relatively small percentage of the purchase price down to obtain a mortgage. So that could range from 0% down if you have a particular loan program, all the way up to 40 or 50% down if you're buying a commercial asset or something akin to that. Typically, it's for an investment property, it's going to be 20% or up, and for your primary residence, it's going to be 3.5% up to 20%. Interest rates are generally very low. In fact, that's one of the major benefits to investing in real estate as an asset class in general, is that you can get very cheap financing, very cheap debt. But the cons to investing, buying property via debt, is that underwriting can be very complex. I think that anybody on this presentation listening to this knows that's ever gotten a mortgage. Getting a mortgage is complicated, and it seems to get more complex the more assets that you have, like the more property that you own, and the more complex your finances are, the more difficult underwriting can be. For a lot of real estate investors, myself included, my salary and compensation is not like a W-2 income. So going to a bank and describing how to get a mortgage, why I'm qualified for a mortgage because I have rental property and I have this and I have that and all that can be very, very complex. Many banks have, asked me for tons of documentation just to get a mortgage. I'm sure many of on this call have had the same thing. You might be limited by the number of properties that you can buy with a mortgage. So for conforming mortgages like Fannie Mae mortgages, I think the limit is something like 10 mortgages. Banks might have their own limits on how much you can buy or can't buy with a mortgage that could restrict your ability to get a mortgage at all. It still requires cash. So you have to put a down payment. You might also have to pay financing fees. You might have to pay renovation costs because you might be able to get a purchase mortgage, but not a renovation mortgage. And so my very first deal I bought with an FHA loan. I put 3.5% down, but I couldn't finance the construction. So I had to come out of pocket for all the construction costs. And very simply, the property that you're buying may not be financeable on acceptable terms. So you might buy a property that is a complete gut renovation, and that's not going to be eligible for a lot of conforming mortgages, or any conforming mortgages, I would guess, besides an FHA 2 or 3K. It might be the case that you can get a mortgage, but the interest rate is going to be exorbitant. You might be able to get a hard money loan or a bridge loan, or a private loan, something like that. But these might all be reasons why debt financing is not effective, and therefore it's not going to be a great way to scale your business beyond possibly doing a few mortgages starting out. So with me, for example, I had 3 mortgages. The first 3 properties that I bought all by myself. And then that was sort of it for my cash outlay. So the next step, or the next evolution, I think, for investors is a joint venture. So I think that, if you're an investor, a real estate investor, you're considering scaling, you want to buy more than 1 or 2 properties, the next step. Yeah, I'm sorry, Stefan, were you saying something?
Yeah, just for a moment, before we move on to the joint venture, can you come back to the prior slide for a second? Yeah. So I just wanted to comment on this point that you made for using financing versus cash. Now, in the private equity structure, as you raise the funds up front, I guess, is it a monetary commitment necessarily that you get, or is it sort of like initially sort of a paper commitment, and at a later date the actual monetary commitment?
Yeah.
So that's, I guess, one question. Okay, and we can get to that. But then second of all, in let's say the scenario of like the monetary commitment is already there. One aspect is, okay, you have sort of unlevered capital raise. So your capital raise is sort of not on a levered basis. You're not using financing. You sort of capital raise everything to purchase with cash, and that kind of affects your IRR in a way, right? If you want to look at a holistic measure of, okay, what's going to be your return subsequently on the whole operation, or project by project, however you look at it. And okay, in the private placement space, where they look at IRR, in a limited sense, but let's say that's what they do, and differently in the private equity space. But still, in that sense, you kind of may a little bit curb the IRR from the cash perspective. It does get the benefit, though, that you can capture much more inefficiency and then sort of take it later. But there is a bit of a timing question there.
Yeah, those are good questions. Yeah, so to answer your first question briefly, I mean, we'll get to that too, but yeah, in a fund structure, you can either typically you have commitments, which are not actual outlays of cash, but you can also call the commitments like immediately, like as soon as you want. But to answer your question about using debt, it's very common in funds to use debt. So you can use debt on the asset level, like you can get a mortgage on a specific asset, or you can get a loan based on the commitments of your fund. So like a credit facility, which is another way that you can use leverage to buy property. So you can either, in my fund, and I'll talk about it at the end, I get leverage on individual assets, like on individual properties, but it's possible to get leverage on the entire fund as a vehicle. Typically, for larger funds, you can get like a credit facility. So to your point, yes, it definitely impacts returns, depending on whether you use leverage or not. But one of the advantages of a fund is that if you don't want to use leverage, there are many funds that are like debt-free funds. You can have a pool of money like dry powder available and just invest with cash. And that's, a strategy that you could deploy for sure. But the strategies that I'm describing here are not necessarily exclusive, right? So you can use debt, cash, even this joint venture structure, which we're going to talk about, I'm going to describe. These are all things that you can do still within the context of a fund for sure. Yeah.
Yes, yeah, exactly. That's very good. Actually, very good response for how you can use leverage in the fund structure.
Totally. Yeah. Totally. Yeah. Yeah. So the joint venture structure, which is as I was describing it, kind of like the step up in your real estate career, like the step up in complexity, as I like to think of it. Very simply, it's the idea of forming an entity to buy real estate with multiple people. So typically the entity is an LLC. You'll form like a single purpose vehicle to buy a single property. You might buy a couple properties or whatever it is. But the advantage of, and I've, before I started a fund, all of my deals with other people were joint ventures, and they were property-specific joint ventures. So the advantage of doing that versus any of the other things that we described is that you can pool together resources from many people to buy a single asset, right? So if I don't have a lot of cash, I can go to my friend, he can give me some cash, we could all split the total cash that we need for a down payment, or for buying the property with cash, we could split the purchase price. And we can also share the risk because we're all involved in the same venture together. There's lots of flexibility in the structure of funds, of joint ventures. So particularly in an LLC, you can have very complex ownership structures, management structure, fees, distributions. So it could be as simple as saying, like, I put in half, you put in half, we each split half of the ownership of the LLC that owns the property, we split all the distributions. Or it can be something really exotic, like I put in a third, you put in 2/3, but I get half of the equity. Whatever else, I get extra fees, maybe because I'm the person managing it, like boots on the ground. I get a different distribution, it's very common. So even though we each own half of the equity, I get a bonus distribution at the end when we sell the property, or maybe when we make rent, get rent from the property, or whatever else. Investors can invest cash. We can also use debt. So like Stefan, to your point about the fund, also in a JV, of course, you can get debt on the asset as well. Partners can contribute sweat equity, for example. It's not uncommon for people to bring in partners that don't bring in cash, but might bring in something really important, like maybe they structured the deal, maybe they have management experience, local connections, construction experience, anything like that. You can scale very easily, so you can buy multiple assets quickly with little cash involved if you have a lot of people involved. And that's how I started scaling, was that I bought 3 properties over the course of about 18 months, I want to say. And then I started working with other investors in this JV structures, a different JV for every property. And then I bought 3 properties, I think in the span of like 4 months. And I kept kind of scaling from there because I didn't have to put a lot of my cash out. I was using other people's cash and then structuring it in advantageous ways for me. You can leverage other exotic financing structures. So I've done deals before where I've essentially treated equity investors in my LLC as debt. So what I did is that I had people that owned part of the LLC, but I said, I can buy you out essentially at my option whenever I want. And typically what I would do is, after say 12 months, I would finance the property. So I'd buy the property in cash, finance it, and then the proceeds of the financing I would use to pay off my equity investors at a certain rate of return. So it's kind of like a hybrid of debt and cash. So I think as investors kind of, as you evolve in your investing career, joint venture is going to be what you evolve to as the first step. But there are some pretty significant cons to doing a joint venture, which is what prompted me to do a fund structure, and what I would suggest that, if you're listening to this, you consider for your own investment. So a major con in my mind is that you need to raise money from a lot of people for a lot of different deals. So raising money, I think, for most people, myself included, is not a fun thing. It's not something that I look forward to, because you're asking people to give you money and you're pitching a product, right? So every time I raised money for a specific property, I created a pitch deck, right? I went through kind of the pros of the property, why to buy it. I created a financial model. I said, here's how the money's going to flow. Here's how we're going to make money. Here's how much money you're going to get, whatever else. I had to schedule meetings with people. So, typically what happens when you're buying a property under this JV structure is one of 2 things, right? You'll identify a property and you'll find it wherever, and you'll say, that property looks really great, I want to buy it. And then after identifying it, you'll go talk to your investors and whatever else, have a phone call, have a Zoom call, whatever it is, do a presentation. Maybe it takes like a week to schedule it. Some people say yes, some people say no. Some people want to talk about the specific terms, sleep on it, think about it, whatever. And then 2 weeks later, you realize that the property that you're talking about is not even on the market anymore, because you waited too long. You waited 2 weeks to respond because you didn't know the investors were interested. Or you could put a down payment on the property, go under contract for the property, and then raise money from investors. But in that case, you're kind of in a time crunch, right? Because you have 30 days or 45 days to raise all the money that you need to buy the property. You might need financing, right? So you have to go to a bank, figure out your financing, all that sort of stuff. It's a huge pain. to do this. Very stressful. So that for me, whenever I bought properties, it was one of those two things. I would lose deals, or I would be super stressed trying to raise money in a very specific period of time. And obviously sellers don't like that, brokers don't like that, because you're kind of it's uncertain if you're going to close. You might even lose your deposit. I've known people that have lost deposits because they've been unable to raise money in the time period to close on the property. I also feel like whenever I raise money in a JV structure, it was reinventing the wheel for each specific property, right? So depending on the property, there might be different terms, there might be different discussions on fees, there might be different discussions on distributions, there might be legal complications, I might have to form the LLC entity, I might have to do all this stuff involved just to kind of get the property, just to get the deal done. Every property is different. Every investor might have their different expectation of what's appropriate and not appropriate. I think the number one question that I get when I talk to people about structuring deals is what is an appropriate way to structure this? Like, what's an appropriate fee to take? What's a normal, acquisition fee, if any? What's a normal split with an investor who's putting up cash, but I'm putting up less cash? All sorts of complexity. And to some extent, that's an advantage, but I think to a lot of investors, that's a big disadvantage because they just don't know what's appropriate and what's normal in this realm. And to be honest, there really is no market. There's many different ways to structure deals depending on how the deal is, what do you think is appropriate, or whatever else. So that alone is a big friction point. I think every single deal that I've done has been structured differently. Every single JV, like different equity, different fees, different splits, whatever else. All a different way of saying that it's hard to move quickly, right? If you're having to do an individual JV for every single property, and you want to buy multiple properties, which is what I do, buying smaller single family or small multifamily assets, it's very hard to move quickly if you're just doing the JV structure. Partners may also be active. So one legal consideration with the JV is that many times partners need to be active participants in the JV to avoid securities laws issues and also taxation stuff and all sorts of problems. So that can cause its own issues. Too many cooks in the kitchen. Like I've had many deals with partners where the partner had a different idea about what to do with the property than I did, and that turned out to be not great. We resolved it in one way or another, but maybe we resolved it in a way that if I was the only person driving the boat, I didn't want to do that. So again, there might be disagreements about the disposition of the property, the use of the property. You might have a falling out with your partners. I've had partners of mine that have gotten divorced while the property has been at play, and then all of a sudden they want to liquidate their investment because they need to partition it in their divorce. People can die. All sorts of things can happen that makes it very complex. And I think to beginning real estate investors, some of these things might seem a little bit like, oh, there's no way that'll ever happen because it's so unlikely. But if you do enough of these deals, you'll find these things. I have lots of war stories about bad JV deals because I just didn't structure it correctly initially. Or maybe, the worst thing for me has been I'll structure a deal and then I'll realize that I really didn't compensate myself enough relative to all the work that I did. Maybe I found the deal, I put it together, I do everything for the deal, and then I don't get anything for it, or I get a $1,000 acquisition fee or something ridiculous. And it's like, well, why am I even doing the deal? Because I put in all the work, I'm not getting any upside. So the solution to these problems, in my mind, the way that I've structured it is a private fund. So we'll get into how the fund solves that problem and why I think it's a great thing to consider for you as an investor. But before I do that, I just want to talk very high level about how to set up a fund because it's important to how we're going to talk about some of the advantages of it. So to set up a fund, typically the attorney that you'll hire will draft all the legal documents for the fund prior to doing anything. So those are the operating agreement or the limited partnership agreement, depending on the structure of the fund. A private placement memorandum is very typical. That's kind of like a summary of the terms and kind of like your pitch for why people should invest in the fund. Subscription agreements, those are legal documents that investors will sign saying, I commit to give money based on the operating agreement. And then typically you'll have a presentation deck or other materials kind of describing how the fund is set up. Sponsors, so you as the sponsor will begin fundraising based on those terms. Investors will commit capital by signing the subscription agreements. And then after that, you'll begin buying assets and deploying capital, and then hopefully your assets will begin generating cash. So unlike the things that we talked about before, the work of the fund happens before you start buying properties. And that's a really significant point to why the fund is advantageous. So when we look at a private fund, again, it's a legal entity to pool money together, capital commitments together to buy assets. The pros, as I see it, in my opinion, are that the legal issues, your compensation, your fees, all that sort of stuff is dealt with prior to investing. And everybody commits to the same fees, so more or less. So unlike in a JV structure where you're reinventing the wheel for every single property, in a fund structure, all that discussion is happening one time at the beginning. So if people don't like the fees that you're taking, the splits, the whatever else, that discussion happens, hour one of the fund. And you can change those documents as you go on and raise money, but you're not reinventing the wheel as you go on. Once the discussions happen, they're done. That's the terms that the entire fund is going to operate on. All the properties that you get are going to be governed by the same terms. You have lots of capital available in the fund structure for scaling and investing. I think that's sort of implicit in what a fund is. But unlike in a JV, again, where you might be doing a JV for a single property or maybe a small handful of properties, in a fund, you have a lot of dry powder, if you will, available to invest. And that means that you can buy stuff quickly and aggressively. I mean, if you need to buy a property tomorrow in the fund structure, you can do that. In fact, in my fund, I have done that. I've been able to tell sellers of property, look, I can close in 15 days. All I need is like a title commitment because I have the money in a bank account, or I have a commitment that I can just call in a week that will give me the cash kind of immediately. So if you're in a highly competitive market, and I think most of the country right now for buyers is a highly competitive market, it's great to be able to move quickly and agilely because you have this money kind of in the bank, literally ready to go, ready to deploy. There's only one decision maker in a fund, that's the GP or the manager. So essentially you, again, that's very typical. I mean, you can have different structures, but very typical in a fund. All of the partners of the fund are passive. All the other members of the fund are passive investors. So only you are driving the boat, only you're making the decision. That's kind of the fun of it for me, right? Is because I get to do everything logistically, operationally with the fund. Me and my partner Ryan get to do everything with the fund. There are many, many different debt and leverage and financing opportunities. We were just talking about that before, Stefan, about how to leverage debt with the fund. But you can get mortgages on the individual assets. You can get a subscription facility for the entire fund, which is like a line of credit, usually at very, very low interest rates, because if you have millions of dollars, kind of in the bank or committed, you can get great terms with banks, and they love to lend to you because they know it's future business for their other lending arms. So there are lots of different structures that you can describe, but the typical structure in a fund, I think, addresses a lot of the issues in the joint venture context, right? You have all the conversations about fees at one time, you raise money one time at the beginning, and you have a lot of capital, dry powder available to invest and go broadly in whatever asset, whatever thing you're wanting to invest in. Obviously, there are downsides, and we'll get to that a little bit too. One of the biggest downsides is the legal complexity of it, and I hope that I can explain a little bit that it's not that complex, not so complex that you shouldn't consider doing it, even if you're not going to raise millions of dollars, but it's not that legally complex. There could be limitations on who you can get as an investor, however. Sometimes funds, depending on your structure, might only be limited to accredited investors, which is generally higher net worth people. Investments are generally illiquid. This is one of the biggest downsides of a fund, is that normally you can't exit a fund for a set period of time. A fund will have like a 6 or an 8 or a 10-year term. And if you exit before that, you really can't. You need to sell your interest to somebody else, and that's very hard to do. So funds are usually even more illiquid than real estate, which itself is a fairly liquid asset. Sometimes investors may not understand the structure or be intimidated by a fund. If you say, I'm raising a fund, you might have to explain to them what that is, how that's different from a JV, how they're going to get paid, whatever else. And then depending on the structure, possibly investing in a JV or in a different structure might be more financially rewarding for you than otherwise. So I think that that's kind of implicit with all these things, right? Like it could be the case that getting massive leverage using your own cash is going to yield a higher return than putting more money down through a JV structure or buying it cash. It could be, depending on the assets, again, that you can get better deals per asset in a JV structure than in a fund. But it depends on the deal, depends on the structure that you do. So I still do investing with JVs, with individual partners in certain properties. And I also do investing via the fund if the asset is kind of in the wheelhouse of what the fund is. So one question that comes up a lot is, what is a syndication? How is a syndication different from like a fund or a JV? Because that term is used a lot in the real estate context. So syndication can be similar legally to a fund structure or a JV structure, but typically it's for a single asset. And typically that happens after the asset is identified. So in the kind of like number two scenario I was describing before about, you find a property, you go under contract, and you have to raise money for it. Often that's a syndication, just a term that really means that you're raising money for a specific asset from different investors after you identify it. But that can be stressful, as I said. You have to identify the asset, put down the deposit. You might not know that you have capital committed already. So it's a mad rush. I mean, people that do syndications talk about this a lot. I've done this too, about the stress of raising money before your deposit goes hard. It's non-refundable. It's a nightmare. You have a lot of the same disadvantages as a JV, right? So you're buying one asset, you need to negotiate fees, equity splits, et cetera, for the specific asset. So you're not really being benefited by calling it a syndication. And depending on your syndication, you could still be governed by the same laws as private funds, although a lot of sponsors ignore this, probably to their peril. But so depending on your syndication, you might actually be forming a fund, but you don't really know that. So again, why a fund? This is kind of my summary of why I think you should consider structuring investments in a fund. First, primarily fees. All discussions about fees and compensation are at the start. Again, when you start the process of raising a fund, those are the conversations, the first things you talk about, way before you're talking about commitments, particular assets, that sort of stuff. Fundraising, again, happens all at the beginning, one time. So if you don't like fundraising, or you think it's stressful, or whatever, I don't have a lot of experience at it, you have a time to fundraise. And then once you fundraise, you're only worried about the operations of the fund. You're not worrying about constantly raising money. You've done it. That phase of real estate is over. The legal work, again, if you're doing a JV or syndication, you're going to have to do legal work for it. But in the fund structure, the legal work is basically done at the beginning. You pay an attorney to set up the fund. You talk with investors about the structure, and then once it's launched, the legal work for the fund is over. You don't have any additional legal work than you would just buying a normal piece of property. Speed, you can buy stuff very quickly without worrying about raising money or legal complications. And I'll describe all these things are relevant to the fund that I operate. But speed, you can move very quickly. Competitive markets, you can be very competitive because you have a lot of just money in the bank ready to go. Capacity, again, typically with a fund, you're raising a pool of money. It doesn't have to be a lot of money, but typically you're talking about hundreds of thousands or millions of dollars, right? So you can buy a lot very quickly. If you don't want to worry about financing, you don't have to, if you want to structure your fund in that way. And then sophistication, right? So this is, I think, not a trivial thing, but a lot of people in the real estate investing space are wondering, like, how can I become a more professional real estate investor, right? Like, maybe I've done one or two deals, I've done a flip, I have a couple buy and hold properties. Like, what's the next level for me? Like, how can I expand my business in a more tangible way? And every private equity firm that you've known about, more or less, in the real estate space, they all started doing, one-off joint ventures with their friends. And then they got more sophisticated, and eventually they all started private funds. So, or many of them did. So all the Brookfields, the Blackstones, and whatever else you want to say, those are, got started in the same way that I'm describing. They raised fund one, which was very small. Fund two is bigger. Fund three is whatever. And now they're raising billions of dollars of funds and have a whole team behind them, and make a lot of their money via carry and management fees. So if you want to kind of level up your real estate expertise, a fund structure is going to be the way to do it, because it allows you to have a lot more dry powder, influence, capacity than you would if you're doing one-off JVs. So why might you not want to structure a fund? So one is, you're not planning to buy multiple assets. Obviously, if you're buying a huge asset, it still might make sense. But if you're not planning to buy a lot of assets, probably the legal work going into it doesn't make sense. You're better off doing a one-off joint venture. If you don't have the track record to raise money from investors prior to identifying deals, it's going to be hard to structure a fund. So often for beginning investors, you just don't have the experience. You haven't done enough deals to be able to make a pitch to investors to say, entrust me with your money and I'll make you more money. That's obviously a huge impediment. For me, I had done 15, 20 plus deals before I started a fund. And that gave me a lot of credibility and a track record to say, I've made money on all these deals. Here's how I dealt with my investors. So I'm going to make you money, hopefully, as well. Another reason could be you don't want to consult a lawyer or an attorney to set up a fund, or you don't have the money to do that. I don't think that's a great reason, but it certainly comes up. Setting up a fund can be, we're talking thousands of dollars in legal fees, possibly tens of thousands, depending on how you're structuring it and what you're doing. Setting up a JV, if you do it the right way, is going to cost money too. It's going to cost thousands of dollars probably. So it's a mixed bag, but I certainly have heard that argument before. Investors may not want to be illiquid. So that's a big, when you raise money for a fund, you might encounter this, which is that investors are saying, well, if the fund is a 6-year fund or an 8-year fund or whatever, and I can't get any money out until after 6 years or 8 years, that hurts because, I want in a JV or whatever, I might be in and out, or I might, be like a private money lender, like a debt financer. And so I'm getting money in and out very quickly. So that might not be a good fit for your investors. And it could be the case that your investors aren't accredited, or there are too many hoops for them to jump through. Like they don't understand the structure. They don't have enough, whatever experience investing. So it's not going to be a good fit for whoever you're talking about. I want to talk about some typical real estate fund terms, and then I'll describe a little bit more in detail about how my fund works. But typical terms for a fund, we went over this at the very beginning, but it's normally a set term, normally several years. So 6+ years is very common. That doesn't mean that you can't be returning capital throughout the fund. So if you have a fund that's focusing on buy and hold investments, you can return capital from rents generated, say, quarterly, annually, whatever you want. But typically the fund has a sunset. So after 6 years, you liquidate the assets or whatever else. There are evergreen funds, but they're a little bit less common in the real estate space. Typically the fund is what's called a blind fund, which means that the GP or the manager makes all investing decisions. You don't consult with the LPs or your other partners about what you're going to invest in. Again, this is not necessarily has to be the case, but very typically that's the structure. And usually that's much preferable for everybody involved, particularly for the GPs, because you don't want 30 or 40 people opining on whether or not you should buy a property or do whatever else. Typically distributions are through waterfall structure, right, as we described at the beginning. So typically that's a return of invested capital and then a preferred return, which is kind of like a guaranteed amount that you'll get. It could be 6%, 8%, 10%, whatever you want. And then a split between the general partner, the manager, and limited partners. And again, those things can be negotiable. An 80-20 split is common, right? So 80% of the proceeds would go to the LPs, 20% to the GP. But depending on the asset class, you could have something very different, 60-40, 50-50, 40-60 in the opposite direction, whatever you want. Typically there's an investment management fee. So to be clear, this is different than a property management fee. A lot of people conflate this, but an investment management fee is a management fee charged by the GP or the investment manager based on committed capital. So typically it's money to keep the lights on. That's what people describe it. It's kind of like pay your own salary just for operating the fund. And that could be anywhere from 1% to 2%, 0% if you'd like. But it's accrued every year, and it's kind of how people will, how a fund sponsor will be compensated when they don't have the split or they don't have carry. Usually there's a minimum investment amount for LPs or investors, 50K, 100K. Bigger funds will have millions of dollars minimum investments. And usually the funds will have a target, net IRR or a target return, very typically above 10%. But if you have a fund that's buying very stable assets, maybe 8% or 6%, or if you have a very aggressive fund, 15%, 20%, all that sort of stuff. But usually that's part of the negotiation, saying, here's how the money is going to flow. I'm going to make you whatever, 12%, 14% on your capital, net of all of the fees, right? So net of the management fee, the acquisition fee, whatever else. This is a typical fund structure. So very, very simple. You have here in the center, this is the actual fund entity. Could be an LLC or an LP. I guess you could even do other legal structures, but very commonly it's an LLC or a limited partnership. The fund itself owns property. So the name, these properties could be held in their own, SPVs or LLCs, but the fund owns these entities. Investors will contribute capital. And the general partner and the investment manager, the general partner gets carried interest. So that's the split that we talked about before after the distribution waterfall, and the investment manager will get the management fee. These could be the same entity. There are some tax reasons and liability reasons why these are split typically, but the carried interest is, the distribution split throughout, and the management fee is the fee on committed capital as you go forward. So I want to touch very briefly on some legal considerations, because that's a big question and a concern that people have when we talk about private funds. So interests in a fund are a security, and that means that the interests are covered by federal securities laws. Obviously, that's a huge area of law that very few people are experts in. Funds rely on exemptions to federal and state securities laws because registering as a security is very challenging and can be very expensive. So every fund that you have ever heard of relies on an exemption to the securities laws to prevent them from registering as a security. The exemptions are different depending on the sort of fund that you're putting together, but they can include things like a limitation on the total amount raised. So you might be limited to $10 million, for example, depending on the fund structure. You might be limited on your ability to do a general solicitation. So something that I said at the very beginning was that this is not an offering for you to invest in my fund. And the reason that I said that is because I'm concerned that I don't want to violate this exemption, because if I'm doing a general offering, I don't know basically anybody on the call except for Stefan, more or less. If I'm doing a general offering, I might run afoul of securities laws, which would be really bad. There could be a limitation on who invests, could be just accredited investors, could be sophisticated investors, could be both. Be a combination of those things. And you might be limited in how you can raise money. So if you're doing a crowdfunding exemption, you might be forced to use certain crowdfunding platforms and websites. There could be other complications into who you can raise money from, maybe not from certain countries, people that have been convicted of certain felonies, et cetera, et cetera, et cetera. So these are all things that an attorney will go over and describe to you. I think that if I describe them in any more detail than this, it would be excruciating. So I'll leave it at this level of complexity. But suffice to say, it's a fairly complex field. So to touch on my fund very briefly, I run a fund called Liberty Hudson Opportunity Zone Fund 1. This is a picture of me on the left and my partner Ryan and Phil Murphy, the governor of New Jersey, and one of our co-investors or partners, Pat Fasano. We were in Atlantic City here a few weeks ago. The governor was down to give a presentation, sign a bill for some COVID relief stuff. But my fund focuses exclusively on investing in a qualified opportunity zone in Atlantic City. And that's this up here. So if you're familiar with Atlantic City, New Jersey, basically all of Atlantic City that borders the Atlantic Ocean is the opportunity zone. And it's where all the casinos are and kind of all the commercial areas of Atlantic City. So the reason why I started this fund is twofold. The first is that I sold a lot of properties in 2020 in Hudson County in Union City, where I got started. I had a lot of capital gains that I didn't want to pay taxes on immediately, as most people wouldn't. So I had two options. I could either 1031 those properties into another property, or I could invest in an opportunity zone. And I decided that I wanted to invest in Atlantic City because I'd already been active there before. And the second reason is I didn't want to continue doing JVs. I thought that was really clunky, very difficult, very tiring. And I wanted to kind of like level up my real estate experience, right? I wanted to evolve. I thought I had the legal knowledge, the investment background, the ability to structure something in this way. And I thought it'd be a great, flexing of my skills to see if I could really structure something like this and really make it successful. So what we do in the fund is we buy and hold single family, small multifamily, and small commercial assets. So that's another reason why the fund structure is very advantageous, because I'm not buying big apartment buildings or whatever. I'm buying really small properties. So I bought properties for $30,000, even less than that, vacant land, all the way up to a few $100,000. But if you can imagine, doing like a JV for every one of those properties is sort of a nightmare. Like, to have to go through all the negotiations and legal complexity and all that to buy a $50,000 property is going to be a waste of time. Like, there's really no amount of money that you can pay me that's going to compensate me for the effort to do that. But in a fund structure, it works great because I can buy 50 of those, bundle them together through the fund, and be successful. So our strategy is value add investment. We buy distressed assets, we renovate them, and then we rent them out as short-term rentals. So in Atlantic City, there's a great arbitrage opportunity right now where you can buy single-family homes or small multifamily homes for next to nothing. I mean, 100 grand, 150 grand, obviously in bad shape, but maybe beach block, 100 feet away from the beach. renovate them. So you put in 100 grand or 200 grand in renovations and rent them out on Airbnb or VRBO to people that go to Atlantic City for vacation and easily can make $50,000, $60,000, $100,000 every year just in revenue alone. So we have assets that we have properties that we bought for, like I said, 30 grand. We put in, say, 100 grand. And in the first year of operation, we made $60,000 in revenue. And so you can do the numbers kind of in your head, figuring out like, what those returns could be. So the goal of the fund is to do more of that. I tell people that we're helping to rebuild Atlantic City because I think that we're taking distressed property and making it better. But at the same time, we're also making great returns, and there's a lot of stuff to buy. And there aren't a lot of sophisticated operators doing this in Atlantic City right now. I mean, we don't really have a lot of competition for the stuff that we're buying. So we've been doing, we launched the fund at the end of last year, and we've been doing really well so far. The fund time horizon is 10 years. So we're holding all the properties for 10 years to maximize the opportunity zone tax benefits. That's part of the opportunity zone law. And we're not raising that much. So I'm raising $3 million, probably from about 15 different investors. We're pretty committed at this point. We have almost fully commitment. We're fully committed in the fund more or less at this point. We're probably ultimately going to buy about 20 different properties and do the same strategy with it. We might launch a parallel fund, which is probably going to have the same, another 3 or 4 million to do a similar strategy elsewhere in Atlantic City. But it's been a refreshing challenge for me to put money together and do it in this way. And I've really enjoyed the challenge. And I've also had a lot of success raising money and deploying capital. So that's it for my presentation. I loved your questions. I saw a lot of questions come in that I didn't answer, I think, throughout this presentation. So I apologize for that. But just before we get to that, if you'd like to contact me, my name is John, John at Liberty. My email address, is John, John at libertyhudson.com. The website for the investment company is libertyhudson.com, or you can go to libertyhudsonsolutions.com. That's our property management arm. I also have a podcast called Brick by Brick, which you can go to by following that link, or you can search in Google Brick X Brick podcast. But on the podcast, I talk more about Atlantic City, private equity, opportunity zone funds, all sorts of stuff. We do a new episode every week. In fact, Stefan, we should have you on the podcast. That would be a lot of fun. But you're welcome to check that out. I also, in happier times, like non-COVID times, I run a meetup in New Jersey. So if you're local to northern New Jersey, I run a meetup called the Brick by Brick Meetup. It's normally in Essex County, but we haven't had that for 15 months or whatever it's been at this point. And I also have a YouTube channel. So it's not about real estate, but if you guys want to hear me talk about a range of topics, some of the topics are about real estate, but it's called That DIY Couple. I do highlight some Atlantic City investments in the channel. So you can see me being silly and talking about lots of different things in the channel. But yeah, so any questions that you guys have, Stefan, maybe if you want to read through some of them that might be easiest. I know there's a bunch, so yeah.
Thanks, John. That was really great. Yeah, so we got a few questions already. So let me help you with that. So the first question, just one moment. So first question could have one moment, just a moment. So it's a kind of a comment. Could have sought a wrap loan from private lender, I guess. Well, I'm not sure what that applied to exactly. Okay, let me move on to the next one. So isn't the mortgage specific to an individual property while the fund is investing in multiple properties? So does that mean going to the banks for a mortgage separately for each property?
Yeah, so yeah, a mortgage can be specific to an asset. You can also get a mortgage that could cover multiple properties. And so the mortgage has a security interest in many properties. But again, with the fund structure, what you can do too is get a credit facility through the fund. So that's a very attractive thing to do. Because a bank will see that you have like $20 million or $200 million, whatever it is, in the bank. The bank will give you like a line of credit essentially to invest on. But yes, mortgages are typically on the asset level.
Yep, that makes sense. And yes, Sue Ellen is commenting their non-recourse loans, which are predicated only on the value of the individual property. That's correct.
Right. Yeah. You can get recourse or non-recourse loans. It depends again on your borrowing potential on the asset, all sorts of stuff. Yeah.
Okay, yeah. So what is the minimum private equity real estate fund size that's needed to buy enough assets that is considered sufficiently diversified either by type or geographically?
I really don't think there's a minimum. I mean, I think I've seen funds that have launched with $100,000, and that might be because they're buying a very specific cheap asset or like vacant land or something like that. There's no requirement, for a fund to be diversified. My fund is not diversified. I buy one specific asset class in one very specific location, and obviously that's part of the part of the pitch is that if you're looking for a diversified investments, like don't put all your money with me. You can put your money with me as part of a diversified portfolio, but I'm not going to diversify your stuff. I'm buying the same asset, like 20 times in this specific area. So, I would say typically funds are in the seven figures, right? Like millions of dollars. That's pretty common. I mean, in the context of the private fund world, the fact that I'm raising like $3 million or $4 million is very, very small. I would say people would even say like a $50 million fund would be small, but there's no reason why you can't do what I'm doing or even smaller. If you're willing to go through some of the legal hoops and pay money to a lawyer to do it, like you can go for it.
Okay, how do you handle additional capital contributions from individuals and the periodic valuation assessment of the assets for additional LPs investing or exiting the fund?
Yeah, so it depends on your operating agreement or the LPA, the limited partnership agreement. So typically investors that come in later might have to pay kind of like a penalty or like an interest rate because you're acting like you've loaned money. Essentially, like the investors have come in later and they're getting the advantage of the fact that the fund started before. So there might be like a catch up a little bit, like an interest rate charge to those investors. Sometimes there are capital calls that happen in a fund in the same way that there would be like in a JV, and those are usually dealt with in the OA, but very typically it's normally like an interest rate or a fee assessed for later investors to come in later than the original investors. But normally in a fund, what will happen is that you'll have closings. So you'll have like an initial closing where a lot of people come in, and then you might wait another month or 3 months to have a subsequent closing or another closing. If you're not doing a management fee, you can have rolling closings. Depends how you want to structure it.
So that you're saying in that scenario, John, so there isn't sort of an intermediate valuation at different time points. It's more like beginning and ending valuation and kind of adjustments for a catch.
Yeah, the actual valuation of the assets may or may not be significant depending on how you're doing distributions. So if there's an occasion that you need to value the assets, you can have appraisals and you can do it that way. But typically, it's pretty simple to figure out your basis in in an asset, right? It's like how much you invested in initially, or the market price of the property or whatever initially. And usually that's sufficient for most purposes because you're making distributions based on like available cash. You're not making distributions based on like appreciation or anything like that.
Okay, and what should a limited partner investor look for in operating agreements and other fund setups to determine that it's fair for both GP and LP?
Yeah, I mean, I think that's a complex question, but typically fees are a big topic to discuss, right? So obviously, general partners, maybe not obviously, but frequently general partners and managers will want to maximize the fees that get paid for stuff, and that can become like a profit center for general partners. So you want to be careful if someone is imposing like fees on everything, right? Like there's an acquisition fee, but also a financing fee and a refinancing fee and a disposition fee and a construction management fee and so that can get really onerous. And you want to look at many times funds will do predictions about the difference between like a gross IRR and a net IRR. Net IRR means net of all the fees, right? So if the net IRR and the gross IRR are way different, then you're probably guessing that the investment manager or the GP is charging like a ton of fees. And that's not great because they might be thinking in their mind, like, I'm not too confident about the investment, like as in the carry, the split that I'm going to get after the preferred return, but I want to like charge up the fees, right? So like if you see a GP charging a lot of fees in their fund, that's usually a bad sign. Another bad sign too is if they're not investing any of their own money or very little of their own money. So like in my fund, of the 3 million, I'm putting in a lot. Me and my partner Ryan are putting in like over a third of the capital. So that's a pretty big sign of our commitment to it and our commitment to the strategy because our money is at stake too. So if a GP is putting in like 1% of the committed capital or 2% of the committed capital, and you're not talking, you know, for a $1 billion fund, sure. But if you're talking about a $5 million fund, they're putting in 2%, like that's a little bit of a red flag. So, you know, why aren't they investing more of their own money?
Makes sense. So what if more than one person wants to be active in the PE fund?
So they could be members of the general partner entity. So general partner is an entity. It doesn't necessarily mean like an individual person, right? So the general partner or the manager of my fund is me and Ryan. So we're both involved in the management of it. So you could have potentially many people like at these huge funds. Like I mentioned, Blackstone, you know, Blackstone is the general partner. The Blackstone entity is the general partner, but Blackstone employs hundreds of thousands of people. So those people are all involved in the, you know, management decisions.
Yeah. So you already spoke on the fees, like the general partner fees for the real estate fund. I guess what is the general holding period for investors? I think like 6 years in your case. So what are the typical values for carry and other fees in a real estate fund? So
investment management fee is anywhere between 1% and 2% typically. Carry, so preferred return is probably 8% is typical, but I've seen anywhere between 6 and 12%, 14%. Again, depends on the asset class. And split with LPs, GPs, 80-20 is very common. 70-30 is not that uncommon. And when I say 80-20, it's 80% to the LP, 20% to the GP. So all of the proceeds after return of capital and the preferred return, then it gets split 20% to the GP, 80% to the LP. But it's really what the asset kind of demands and how you want to structure it. But just because the split is less favorable doesn't necessarily mean that it's a worse investment opportunity. Like to the question before about gauging whether or not it's a good investment, I often say, you know, look at what the anticipated return is, or what the financials are. If you think that the net return of the fund is what you want to see, then on the one perspective, it doesn't really matter exactly how much the GP is being compensated, right? So even if the GP is getting a lot of money, but you're making 15%, 14%, whatever it is on your money, if you're okay with that and you believe in the thesis and you believe in the investor running it, then that's okay. I mean, that's not necessarily a bad structuring of it. But in the world of like super huge private equity, you'll see like an 80-20 split is very common.
And I think you already mentioned for like the sort of typical amount to raise at the beginning, I guess. So the question, do you need millions of dollars to raise? I guess, I mean, it sounds like it. You did mention some scenarios, if you want, you could do it with even hundreds of thousands or like pretty small amount if you have
For sure.
legal capacity.
For sure. Yep.
Yeah. So, okay. So when raising money in a fund JV, are you subject to the SEC considerations like there is in a syndication?
In a JV structure, typically no, because typically the partners that are involved are all active partners. So it depends on your definition of a security. That's a whole other aspect of law, but determining what is security and what isn't a security is somewhat complex. Typically in a JV, the interests that you're selling are not necessarily securities, but there are some scenarios where they could be. So if you have like a passive partner and you're improving the asset, you have like not a very certain expectation of gain, that could be a security in certain contexts. So when you're structuring a JV, I always say to people, like, just talk to an attorney if you've done it before, just to make sure that everything is okay. It's worth the money. Securities laws are no joke. I mean, there's criminal liability for violating securities laws in addition to financial penalties. So, you know, maybe your investors, maybe nobody will care because everybody makes money, everybody's happy. But my wife, who's a securities attorney, has seen these things go bad and people go to jail. So it's no joke. Yeah.
What's the tax treatment for the returns? Is it that 250K capital gains tax exemption or based on long-term capital gains or carried interest?
So with a fund, it's taxed in the same way that a JV or a partnership might be. So it's all passed through taxation. So whatever the taxation would be kind of at like the asset level is what you get. So if you flip a property through a fund and you have short-term capital gains, then you get passed through that. If it's a long-term hold, then you get long-term capital gains. From a GP perspective, obviously the carried interest loophole, if you want to describe it, is beneficial. So typically carry is taxed at long-term capital gains rates, which is very advantageous. So normally a fund structure is advantageous for investors if they're looking to kind of minimize taxes. An opportunity zone in particular is advantageous because an opportunity zone fund takes advantage of opportunity zone laws that defer capital gains taxes. And after 10 years, your basis in the property is equal to the sale price of the property, the market value of the property. So basically it's no taxation. So that's the big advantage of being in an opportunity zone fund specifically. But a fund itself is kind of just the same as a partnership for taxation reasons. It's all passed through.
So how do you go about liquidating the fund at the end of the period? So you mentioned after 6 years, you can't liquidate the assets, but how does it happen? You have, let's say, 50 different properties.
Yeah, so there are lots of things you could do. You could extend the lifetime of the fund if you don't want to exit and everybody agrees to that, or a certain subset of investors agree to that. You could spin the properties off as their own individual JVs with individual investors of the fund. You could start a new fund to buy those new assets. The idea of the fund having a set lifespan is normally that that you want to go through like one economic cycle, right? So like say an economic cycle is 10 years or something, right? You want to have, or 6 years, 8 years, you want to have the fund active throughout the whole cycle so that at some point in the life cycle of the fund, it'll be advantageous to sell the asset. So usually after 6 years, very typically funds will have extensions of 1, 2, 3, 4 years, something like that. So maybe it's not great to sell in 6 years, but in 7 years it is, 8 years it is, 9 years it is, or maybe you sold in year 3 or year 4, and you're returning capital early or something like that. So that's the idea behind the structure. Very typically, all of my investments, I even stuff that I said I'm going to buy and hold forever, I've sold, like after 4 or 5, 6 years, just because the market opportunity presented itself. So that's very typical for funds. Like you'll find a way to sell because it's not that you have to, just that the market opportunity is there to sell.
But you could also continue owning those assets. It's just it's a legal liquidation of the fund. You could, in theory,
you could spin those off as JVs. You could say, instead of liquidating cash, I'm going to just give you part of an asset, and it's just going to be 30 different JVs of 30 different properties, and we'll just keep going that way. Yeah,
makes sense. Okay, got it. So isn't it too late to start up an OZ fund?
No, it's not too late. There's one hard-coded date in law, which is that capital gains deferrals exist until 2026. So every year that you get closer to 2026, some of the tax benefits of an OZ fund decrease. But the big tax benefit for me is that after 10 years, your basis in the property adjusts to the sale price of the property. So there's kind of two benefits. One is that you can defer capital gains payments that you accrue right now until 2026. And the other is that your basis in the properties will increase after you own them for 10 years. So for like the deferral to 2026, it gets less advantageous. Obviously, every year you get closer to 2026 if they don't change that law, but you still get the big capital gains step up at the end of 10 years, which I think is the biggest advantage.
Okay, so another question: why not just invest in Fundrise or other real estate crowdfunding? What are the pros and cons versus investing in a real estate private equity fund? I mean, those could be fun.
Yeah, so I mean, yeah, you could. I mean, Fundrise, you're basically investing into a fund through different vehicles that Fundrise will have, or some of these other things. I mean, maybe you're investing in a JV, but I think on the back end, a lot of their things are structured legally like a fund. So there's really not a huge amount of difference, except that Fundrise is just like a crowdfunding, tech-enabled solution. But investing in private equity, I think on Fundrise, right, you get kind of whoever, right? Maybe you can see their track record, you can see whatever else, but there's not a whole lot of transparency often not that much transparency into like the actual investors, the actual asset class. You get to meet the people, maybe you don't get to see the asset, whatever else. When you're investing in private equity, it's kind of like, like if someone is investing in my fund, I'm the person talking to them. They can ask me questions. They can talk to me directly. I'm the person making the investment decisions, or Ryan is making the investment decisions. They can talk to both of us. So you could do that, but it's kind of like a different chapter of the same book. It's just private equity through a facilitator.
How much does it cost to set up a private fund?
So it can range. I mean, that's one of the bigger impediments, but I would say you're looking at thousands of dollars, probably looking at, $10,000. I mean, that's probably like for a reputable attorney to set it up, who knows what they're doing, to do everything, like worry about the regulations and your filings and guide you through the process. Close investor, it's probably going to do something in that realm.
So then it's just as comment on my side, then it's kind of similar to an individual deal, to a syndication in that scenario, right? Which I would presume is.
It could be, yeah. Yeah, it could be, yeah. Yeah. Yep.
Yeah.
Yeah.
Sort of similar order of magnitude. Okay,
Yep.
sounds good. And yeah, so do investors get the bulk of the depreciation? How do the new depreciation tax laws affect their returns and your cost of capital?
So yeah, it's passed through, right? So any advantages that you get in the asset level are passed through. So the new depreciation laws, et cetera, it's you get that, like, as an individual investor, whatever advantages you get, you would normally get just by owning an individual asset. It's the same thing you get through a fund. It's all passed through. It's a partnership.
Would you say that the offerings in crowdfunding platforms are bottom of the barrel? Those raise capital elsewhere.
Yeah, I think that's the reputation, right? I think it's like newer investors, like newer sponsors or people that can't find money elsewhere. It's probably cheaper for investors for sponsors to get money not through Fundrise, but I guess there's a time and a place for that. I really don't know a lot about their offerings, so I shouldn't denigrate them unnecessarily, but that's the reputation, yeah.
Okay. How about the fund for new construction, specialized homes? I guess they will sell every 18 months or so. Should the proceeds be paid out or used to build more, or does it all depend on the structure?
Can you say that again? So I'm not sure I understand that question.
Speculative, never mind, sorry. How about the fund for new construction, speculative homes? They will sell every 18 months or so. Should proceeds be paid out or used to build more? Or does it all depend on the structure?
Yeah, you can do that. I mean, that's not uncommon to have a fund to build attractive homes or one, big structure or whatever, and then recycle the fund or start a new fund. Depends how you want to structure it. Yeah, I mean, it's, again, with like a fund or a JV or whatever, there's a lot of ease. Like there's a lot of things you can structure in different ways. So if you want to have a fund that's like an 18-month time horizon to build 10 homes on 10 pieces of land, like that's great. That could totally make sense.
Okay. So John, so you mentioned just before we wrap up, we're already over time. Thanks so much for answering all these questions.
Oh, sure. Yeah.
And so just one question on my side. Like, since you mentioned it's okay, one of the factors is kind of less stressful to capital raise up front. The necessary commitment. You don't need to do it like in bits, sort of in parts. For every single deal you find, and it's sort of like time constraint, etc. Time constraint. But in that sense, isn't there like a different source of stress that arises from the fact that, okay, you sort of large batch, you capital raise a bigger amount than it otherwise would be, or amount would be, and then you need to find like implementation for all that capital. You sort of need to find its place in a timely manner. So
totally.
Yeah, how do you handle this in terms of?
I think that's a great question. I mean, obviously, like real estate investing is not without stress, right? So you're kind of substituting one type of stress for a different type of stress. But one advantage with the fund is that to one of your first questions, Stefan, about do you have committed capital or do you have cash? Like generally, you're not obligated to call up the capital that you have committed immediately. So you might have years, depending on this fund structure, to call capital, right? So like, an investor will say in day one, I'm going to give you $100,000, but you might not actually get their $100,000 or need their $100,000 for a year or 2 years or 3 years or whatever. And that's totally fine. So that, is one way to take the stress off, is that I have a little bit of time to deploy the capital. But I think really to do a fund, you need to have a thesis, right? You need to have a rationale for doing it. And I think if you have a really strong thesis and a really strong rationale, and you believe in it, you can find the assets to do that, right? Like I wouldn't start a fund if I was just kind of like, well, maybe I'd buy some properties somewhere opportunistically, right? My fund has like a thesis, it's like I'm buying a specific type of property in Atlantic City for a specific type of reason at a specific time frame to do that. So, for an investor that is just kind of like going to just buy whatever they can opportunistically, I don't know if a fund is the best structure, but like for me, because I'm like driven and I know exactly what I want to do, it makes it easy because it's like my limitation before the fund was capital. It wasn't like deals or like how I'm going to make money. It was like, I know what the deals are. I know how to find them. I know how to make money. I just need to fuel the vehicle to make the money. So if you're in a position like that, the stress is not really like deploying capital. It's just like operational stress. It's like can I like close the deals? Like, can I renovate the properties? Can I, do that sort of stuff? Yeah.
And on that part, how do you scale that? Like, how do you do like 50 different small multifamily or single family properties?
Yeah. So you have to build a team, right? And so that's kind of what the management fee.
Construction firm and the property management you mentioned, and right.
Yeah. So like, that's like what the, like we talked a bit about the investment management fee as being separate from all the other fees. That's a fee on committed capital. That's the fee that allows you to grow your team, right? So maybe you're getting in 100K, 200K, 300K a year just from your investment management fee. That goes to the salary of your investment analyst or your project manager or whatever it might be, right? So you can build a team to deploy the money. That's very common in funds to have, you hire people for the fund, right? Again, like Blackstone, Brookfield, they have hundreds of people that are investment analysts and project managers and all that sort of stuff. And so that's like the way to scale, right? You have a team, you have more capacity, you have that. And so that's kind of, what we're doing. Like, it's me and Ryan primarily, but now we have people that are full-time property managers. We have construction people that are full-time. We have people that contract for us, that find deals for us. So it's part of our scaling process to deploy it. Yeah.
Makes sense. And what you mentioned for the capital commitments in terms of like when people need to, in some scenario, let's say their capital may not be deployed, let's say within a year later or 2 years later. So how are they fine with making the commitment in such a scenario that it's not a very defined, starting date, let's say?
Yeah, I mean, it's part of the whatever, upside or downside of investing in the fund, right? We had a commitment saying like, on 2 weeks' notice, I'll give you $100,000, but who knows when that could be. But that also drives returns, right? Because generally your return for an investor is based on when you get their money, not when they commit the money. So from a fund perspective, it's advantageous to wait, right? Because you want to make good returns for your investors. So if you can wait 2 or 3 years to actually get the capital and then invest it, that's better because it kind of juices returns. And like to the credit facility thing I mentioned before, like what a lot of big funds will do is they have $1 billion of commitments and they'll go to a bank and say, give me a humongous credit facility on $1 billion. I'll use that credit facility for as long as I can. And at the last moment, when I have to pay back the credit facility, I'll then call the capital and, I will, deploy it at that point. But that super juices returns, right? Because maybe I could buy a property, stabilize it all, et cetera, just on credit. I don't have to like get money at all. So that can really juice returns. Because it's like, yeah, you have $1 billion, but maybe you're only deploying it for like 18 months, right? So like the returns on that are astronomical, hypothetically. That's not what we do, but that's how some bigger funds work.
Yep, makes sense. But to that investor whose capital, let's say, was deployed at a later stage, he would nevertheless have the aggregate return of the fund still, right? So it's not a return that's attributed to his. That's the meaning for funds.
Yeah. So yeah, normally what happens is that funds are called pro rata, right? So it's not like you can say, I'm going to wait, like you committed $100,000 and I'm not going to call your specific $100,000 for 2 years. It's like, I only need 20% right now. So I'm going to call 20,000 of your 100,000, and then I'm going to call 10%, and then I'm going to call 50%. So like, over time it'll be the full commitment, but it's all scales. It's usually not the case. I can't imagine a structure where it's like, I'm only going to call your specific money first. That would be very strange. Yeah.
But your returns are not going to be tied to when your specific capital was called, right? It's going to be the aggregate return of the fund since inception. It's not
right, but yeah, but how I'm calculating the return for like the preferred return or whatever is based on like when I actually called the money. I'm not calculating it based on like day one of the fund.
Okay, got it.
Yeah.
Okay, yeah. So last question. Let's wrap up. So, what's your return on investment in your fund? I think it's. I don't know if it's maybe too early to say.
Yeah. So what I tell investors is 14% net return, like IRR basis. That's, I think been borne out by the performance of my other investments. And my fund is a little bit different. I don't charge a management fee, for example, a net investment management fee, because I have a higher split. So my compensation is on the back end. I have like a different carry split than other funds. But again, it just goes to the fact that you can have a lot of different structures. And to my point before about caring about returns, I think from an investor perspective, like a passive investor looking to invest in funds, what you should really care about is the return to you and how much you believe that that's going to happen and, believe in the sponsor. So even if the fees and this and that are obviously lots of fees are bad because that indicates that the sponsors being paid just from fees. But whatever the fees are and the splits are, I think that's not as important as just looking at what the returns are. And if you're comfortable with that, make an investment. Yeah.
Great. Thanks so much. Really appreciate it.
Thanks, Stefan, everybody, for listening. And yeah, feel free to contact me if you have any questions. I'm more than happy to talk about it. I love helping investors for, not selling anything. So just reach out. Yeah.
Yeah, everyone. So just make sure you can reach him at his website, his email address. So there's his podcast and meetup as well. So yeah, with that, thank you so much. Thank you everyone for joining tonight.
Yep. Thank you guys. Take care. Bye.